Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about KADANT Inc. Annual Report. KADANT Inc. offers a diverse range of technologies and engineered systems across three primary segments: flow control, industrial processing, and material handling. The company's flow control segment provides fluid handling systems and equipment, including rotary joints, siphons, turbulator bars, expansion joints, and engineered steam and condensate systems. Additionally, it offers doctoring, cleaning, and filtration systems, as well as related consumables such as doctor blades and water filtration systems. In the industrial processing segment, KADANT develops and manufactures equipment for various industries, including ring and rotary debarkers, stranders, chippers, engineered knife systems, industrial automation and control, recycling and approach flow systems, and virgin pulping process equipment. These products cater to the packaging, tissue, wood products, and alternative fuel sectors. The material handling segment offers conveying and vibratory equipment, baling products, biodegradable granules for agricultural and lawn care applications, as well as absorbent granules for oil and grease absorption. The company markets its products through direct sales, independent agents, and distributors, providing a comprehensive range of services to meet the needs of various industries worldwide. Unfortunately, I do not have access to the text you provided. However, I can still provide a general overview essay on what might cause a stock price to drop. The stock price of any company can fluctuate due to various market and economic factors. One possible reason for a decline in KADANT Inc.'s stock price is a decrease in demand for its products or services. This could be due to changes in the industry, increased competition, or a shift in consumer preferences. Another factor that might contribute to a drop in stock price is poor financial performance. If a company reports lower than expected earnings, revenue decline, or increased debt, investors may lose confidence and sell their shares, leading to a decrease in stock value. Additionally, external factors such as changes in government policies, economic downturns, or global events can also impact a company's stock price. For instance, if a major customer of KADANT Inc. experiences financial difficulties, it could lead to a decline in demand for the company's products and subsequently affect its stock price. Lastly, internal issues within the company such as leadership changes, restructuring, or scandals can also negatively impact investor confidence and cause a drop in stock price. KADANT Inc. maintains a market capitalization of $4 billion, broadly in line with the industry peer group. KADANT Inc. trades at a higher price-to-earnings ratio of 40 times and a higher price-to-book ratio of 4.13 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The company maintains a moderate leverage profile, with liabilities making up 40% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have increased over the past 5 years, which is normal for a growing company. Asset and equity growth have outpaced liabilities, suggesting balanced and healthy expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified through a thorough analysis of the company's financials and operations. In this case, the flow control segment experienced significant revenue growth of 16.4%, while the industrial processing segment saw a decline of 6.2%. The material handling segment also reported a notable revenue growth of 12.5%. The geographical analysis reveals that the United States was the largest contributor to revenue growth, with a substantial increase in revenue from $448,600,000 in 2023 to $534,041,000 in 2026. Canada also experienced significant revenue growth during this period. In contrast, China was the only region that saw a decline in revenue. The gross profit margins of each segment provide further insight into the drivers of revenue growth or decline. The flow control segment had a high gross profit margin of 51.8%, indicating strong profitability and potential for continued growth. On the other hand, the industrial processing segment's low gross profit margin of 40.2% may have contributed to its decline in revenue. Overall, the company's revenue growth can be attributed to the strong performance of the flow control and material handling segments, as well as the significant contribution from the United States and Canada markets. Net income for the company decreased by $8.9 million from 2024 to 2025, resulting in a net income of $103.7 million. This decline can be attributed to various factors, including delays in customers securing financing due to economic uncertainty and tariffs imposed on capital equipment. The profit margins also underwent significant changes during this period. The gross profit margin increased by 90 basis points to 45.2%, but decreased across all segments. On the other hand, operating income margin declined in certain segments such as flow control and industrial processing. One of the key reasons for these changes is the impact of tariffs and trade sanctions on demand for capital equipment. Additionally, acquisition-related costs, integration costs, impairment charges, and changes in interest expense also contributed to the decline in net income and profit margins. The company's financial performance indicates a strong ability to generate cash from its operations. According to various summaries, the estimated operating cash flow for the period is $88.1 million, which is a significant amount. Furthermore, the net cash provided by operating activities for January 3, 2026, is reported as $171,328,000, demonstrating a substantial inflow of cash from operating activities. The company's ability to generate positive operating cash flow can be attributed to two key factors: a reduction in working capital outflows and an increase in customer payments. This suggests that the company has been able to manage its working capital more efficiently, resulting in lower outlays and higher inflows of cash. As a result, the company is generating sufficient cash from its operations to meet its financial obligations. The consistency of this positive trend across multiple summaries reinforces the conclusion that the company is indeed generating positive operating cash flow. This is a crucial indicator of a company's financial health, as it suggests that the business is able to cover its expenses and invest in growth initiatives without relying on external funding sources. The company's debt level and interest expenses have undergone significant changes over the past few years. Initially, the aggregate borrowing capacity increased from $400 million to $750 million, indicating an expansion of the company's financial flexibility. However, this increase was not accompanied by a proportional rise in long-term debt, which remained relatively stable at around $366.7 million. In terms of interest expenses, there has been a mixed trend. On one hand, interest expense decreased by 22% from $20 million in 2024 to $15.6 million in 2025, indicating a reduction in the company's borrowing costs. However, this decrease was short-lived as interest payments on outstanding debt obligations increased in 2025 compared to 2024. Furthermore, an interest rate increase of 10% led to a rise in interest expense by $1.2 million in 2025. Despite these fluctuations, it is clear that the company's interest expenses have not remained static. The trend suggests that while there may be periods of decrease, the overall direction of interest expenses has been upward, with some exceptions. The performance of various segments and regions in the industry has been mixed, with some experiencing significant declines, while others have shown minor fluctuations or no notable changes. In terms of segments that performed poorly, the industrial processing segment and the OSB market were particularly affected due to decreased residential construction activity and loss of significant customers or reduced capital spending by customers. These factors led to a decline in sales and revenue for these segments. Geographically, China was another region that struggled, with government policies and restrictions contributing to variable sales, credit risks, and uncertainty in bookings and revenues. Europe also faced challenges, although it was not explicitly stated as performing poorly. Foreign currency translation exposure was noted. On the other hand, some regions and segments showed minor fluctuations or no specific information was provided. The material handling segment, flow control segment, North America, and Europe were among those that did not experience significant declines. Management's outlook for the company is optimistic, driven by a strategy that emphasizes long-term growth through acquisitions. The company plans to acquire businesses and technologies that complement its existing products and services, leveraging its large installed base of equipment globally. To achieve this goal, management will continue to prioritize global presence, local support, and problem-solving relationships with customers. The company anticipates higher bookings in 2026, particularly in the industrial processing segment, and expects steady demand for aftermarket parts while strengthening demand for capital equipment products. Management is confident that existing cash and cash equivalents, along with cash generated from operations and borrowing capacity, will be sufficient to meet the company's capital requirements for the next 12 months and foreseeable future. To mitigate risks, management is implementing various strategies, including combining sales and marketing operations, finding new markets, developing cross-selling opportunities, and implementing corporate efficiency programs. These efforts aim to drive growth, improve competitiveness, and address potential challenges such as economic uncertainty, cybersecurity threats, climate change, and tax law changes. The company has a history of distributing its profits to shareholders through dividends and share buybacks. In terms of dividend payments, the company has consistently paid out significant amounts each year, with $15.8 million in 2025 and $14.7 million in 2024. Additionally, there is evidence that the company continued to pay dividends in 2026, with a payment of $4 million made in February of that year. The company has also engaged in share buybacks, with up to $50 million of equity securities authorized for repurchase from May 15, 2025 to May 15, 2026. This indicates that the company is committed to returning value to its shareholders through both dividend payments and strategic share purchases. Concerns about inventory buildup and supply chain disruption are evident in several areas. Inventory buildup is a significant operating cash outflow associated with working capital, and assumptions about future dispositions of inventory are inherently uncertain. This has resulted in write-downs of inventory, indicating potential losses due to unsold or obsolete products. Supply chain disruptions have also been a major concern. Supply chain constraints, inflationary pressure, port congestion, and increased freight costs have negatively impacted gross profit margins. Temporary closures of facilities or disruptions in the supply chain can occur due to various reasons such as health epidemics, pandemics, single-source suppliers, and trade sanctions. Geopolitical shifts and regional instability also pose a threat to global supply chains. Tariffs imposed on imports from China, trade sanctions targeting countries like China and Russia, and military conflict between Russia and Ukraine have disrupted global trade and logistics. These disruptions can lead to significant decreases in bookings or delays in shipments due to overcapacity in the Chinese pulp and paper industry. Furthermore, restructuring costs associated with the closure of several mills in Europe have resulted in excess production capacity and declining demand for capital equipment products. This has led customers to defer capital expenditures pending greater clarity regarding input costs and broader economic conditions. That concludes the financial summary for KADANT Inc. Feel free to comment below, and I will be happy to answer them when possible.